So they kind of have to balance it out, right?
Yeah,
In one way or the other, they have to kind of make sure that they balance it and they don't overdo either of them. You can probably get perfect employment that would cause a lot of inflation. That's probably kind of very, very difficult, but you could
yeah,
potentially do that. But at the same time, it can also be that you get zero inflation, but then you have a lot of unemployment because the reason why prices aren't going up is because people can't afford to buy those. So that's why you can't.
wow.
Yeah.
Hi everyone, welcome to another episode of the Shaft podcast. My name is Andrews, and I'll be your host for this one. This is another version of another episode on the Shaft conversations. Recently, we've had several discussions around, let's say, important areas in the world. We've had a discussion on AI and its growth and integration into things that have happened. We've talked about the media and how it's interacting with politics and certain election expectations. On this episode, we'll talk about the economy. And I know a lot of people experience it, live in it, but we most of the time also do not understand exactly what is happening. And recently, I made a mention on a past episode that, look, when we talk about, for instance, inflation, economists tell us 317.5 million different things that could cause inflation, and we still cannot pinpoint exactly which of them is causing inflation at whatever point in time. And you say this and they say that. So, yeah, on this episode, we are here with a very, very informed person on economics as well. So, I'm here with Shorodip Paul. Now, Shorodip is a former employee of the World Bank, so he used to work with the World Bank. But also, what made me understand that he probably understands economics is that when you come to the world of debating, economics is difficult. It's a thing that people run away from. And this guy won a World's University Debate Championship final on an economics motion. And for me, that was one of the most fascinating speeches I had heard as well, especially because it's on a subject area that's almost too difficult to debate all the time. But over here, we're not going to have like the technical debate discussion. So, on this episode is mainly let's look at real world economics. How do they really work? The discussions we do not get to have, the complex things we read and we really do not understand. Paul is here to help us break it down. So, thanks, Paul. Welcome to the Shaft podcast, and thank you so much for joining us on this episode.
Thank you so much for having me. I've heard a lot about the podcast, so I'm very, very excited to be here.
Yeah. I mean, we started about a year ago. Started publishing consistently, and I think we've never looked back. We've published at least one episode every week, so it's been growing and it's been good so far. Yeah, but let's just kickstart it maybe on a lighter note. What are the biggest myths you hear about economics that people claim that you know from your studies and from your work and from your practice that they are false? But in the public's eye, they tend to assert to those a lot. Also within debate spaces, what are some of the biggest fallacies about economics that you heard people speak about?
Well, there's so many fallacies on economics, I would say. Oftentimes, I think what a lot of debaters tend to say, especially having worked in that space, right?
Yeah,
With regards to like the World Bank, the government, etc. Oftentimes, people generalize a lot. They're like,
yeah,
yeah, expanding government programs is always a good thing, whereas in reality, you'll see that, oh my God, it's not as like nice as people put it out. There's so many operational
yeah,
challenges to it. Or things like, oh, debt is always a bad thing. Or, for
yeah,
example, people making arguments on, oh, this country is going on into debt and therefore it's going to be a bad thing. And I just go on, right. Obviously, a lot of this is context dependent. Sure, government spending can be
yeah,
good, but context dependent. Debt can be good, context dependent. Debt can also be bad, again, context
yeah,
dependent. But I've seen people make a lot of these generalizations all the time. I debate in other discussions as well. Yeah.
yeah. I mean, it's fair as well. I think maybe some of them are also shaped by public opinion about some of these things. So generally, being in debt is viewed as a negative position to be in. Therefore, anyone who is in debt is doing a bad thing or something of that sort. But I mean, for this conversation, I want us to narrow down to, let's say, the biggest determinants of what global economy have become. We saw one in 2008, we saw one in 2019, 2020, which are more like global economic crisis. Obviously, in 2008, it was the US economy, the housing system crashing, and then we saw a spillover into the world economics. We saw in 2020 COVID-19 leading to the shutdown of so many complex things that economists will tell us about supply chain, trading, and all that, eventually crippling the economies as well. How different are these two events? Because in my eyes, I see both of them as, yeah, maybe recessions or two similar economic crashes that the world experienced. But from your perspective, where you sit, are they significantly different in the way in which they occurred and the influence they had on the world post their occurrence?
They're definitely very, very different because, as you pointed out, the 2008 financial crisis was very initially, at least, localized to the United States of America. But the problem is
Yeah,
the United States of America is very integrated within the world system. So whenever there's a problem with the United States financial system, it spreads like contagion
yeah,
across borders. It goes to Europe, it goes to Africa, it goes to Asia, and it kind of affects the entirety of the global market. However, that happens due to a contagion effect, whereas the COVID-19 crisis kind of hit everyone. Like it
yeah,
pretty much hit everyone in one way or the other. You didn't need to be intertwined with the United States economy per se to be affected by it. You were affected by it regardless because
yeah,
COVID-19 affected everyone and economic activity went down. People were locked into their houses. They stopped spending. It was very difficult to produce things because if people aren't going to factories, they're not producing things. And if
yeah,
people aren't producing things or buying things at the same time, that's the kind of an economic crisis that we find ourselves in because our economic system kind of depends on if even if I'm oversimplifying, it kind of depends on people producing stuff, us buying stuff, and in the process
yeah,
people earning money and they also buying stuff and then other people producing stuff. So that's what happens within the economy, and that got the shock. Whereas in the 2008 financial crisis, it was because of the housing market crash in the United States, where the banks and the investment banks and the insurance companies made a bunch of terrible
yeah,
decisions, which led to the housing market crash, where they gave out loans to people they shouldn't not have, and that spread as a contagion. And I think I would say there are some key points of differences, right?
yeah.
And the first one being that the 2008 financial crisis started within the financial system. Like it happened
Okay.
within the housing market, but it ultimately affected the financial system. As you can see, the institutions getting bankrupt initially were like insurance companies, banks,
Yeah,
investment banks. Whereas in the 2020, the pandemic, um, it was kind of like a lot of the institutions or companies or factories that were hard hit were manufacturing industry, was the tourism industry, for example, because the people were not able to travel. So it affected the
yeah.
real economy a lot more, I would say, versus the
Okay.
financial economy being affected in 2008. Not to say that, like, obviously 2008 also had an impact on the real economy that came
Yeah,
through a chain of events. However, this was a direct hit on the real economy, and even then a lot of ways in which it was dealt with was very different as well. So
yeah,
for example, in the 2008 financial crisis, what the US president was like, we're going to have to bail out the banks because a lot of people argue that that wasn't probably the best thing to do. However, we know that there is a majority consensus in a lot of cases that you kind of had to do that because the banks were going down.
yeah,
Otherwise, you could have created a far worse problem. However, in the 2020 financial crisis, what we see is there are different approaches. Like, for example, Joe Biden had a stimulus package where they literally just
yeah,
handed out money to people. That
yeah,
kind of solution wouldn't have worked in 2008, and the 2008 kind of solution probably wouldn't have worked in 2020. So,
yeah,
like, vastly different kind of crisis that affected people very, very
yeah.
differently.
I mean, quite interesting descriptions there for both of them. So I have two follow-up questions on this, but first is given the direct hit on the economy by COVID versus the indirect through the financial system in 2008, does that dictate, for instance, the intensity of the impact on the economy, the scope of the impact on the economy, and how bad things get?
Yeah, absolutely, it does. Like the way in which it happens, the intensity is very, very different in these two different scenarios. I'll give you an example. So I'll give you an example from my home country, Bangladesh. Bangladesh
Okay.
wasn't really affected by the 2008 financial crisis. And the reasoning behind this is,
Yeah.
one, we don't really have an advanced financial system. We're not integrated with the US economy in any way. Second is our main exports are very basic. Like our main
Yeah.
export is ready-made garments, And
Yeah.
the demand for clothing may shrink a bit in a financial crisis, but it doesn't shrink by substantial amounts, so such that it affects a country that's dependent on its export. And a lot of the
Yeah.
Bangladeshi economy is also agricultural, so it didn't really get affected as much during the 2008
Yeah.
financial crisis. However, within the 2020, the COVID crisis, we got affected
Yeah.
in so many ways. Like people are defaulting on loans because there were so many, like there's so many businesses that run on loans. So for example, like if there
Yeah.
was a hotel that took a loan to increase or extend its facilities in a particular area in the tourism
Yeah.
industry, it wouldn't be able to pay back that loan simply because they were not
Yeah.
making the amount of money that is required for you to pay back that loan. And that's just one instance, right? There's so many different instances of this happening all across the economy, which meant that you had to either, like, reservice the debt. You had to be like, okay, we'll extend the
Yeah.
terms and conditions, we'll let you pay it later on. Or like you had to tell them, okay, no, you are a defaulter now, you have defaulted on your loan and we're going to take away your assets. Either ways, neither of these outcomes are good for the economy. And that happens in every country, and regardless of, like, even Bangladesh was affected in so many ways because of that. So that's the crucial distinction, right? One where you are integrated with the US financial system in one way. To be honest, every country is integrated with the US financial system because of the dollar reserve, right? Because of the fact that
Yeah.
we use dollar as the currency.
Yeah.
However, the degree of it varies. Like, obviously, the
Yeah.
UK is going to be affected a lot more because they integrated with the US financial system a lot more than, say, a country like Bangladesh, or say a country like Rwanda, for example,
Yeah.
because again, the degree of integration is different. However, the COVID-19 crisis kind of hit everyone in different ways. I wouldn't say equally, but the 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 differences between countries in 2008 was far greater than the differences in countries in 2020.
Okay.
Very, like, in 2020, almost every country was affected in one way or the other. We could all
Yeah.
relate to our problems,
Yeah.
one way or
Yeah.
the other, because it was very similar in the way in which other problems happen, like unemployment happening. Because, like, why would a restaurant employ waiters when the only person working in that restaurant is the delivery person, right? So
Yeah.
that's a problem that has happened in every country. So
Yeah.
yeah, I think that is something that is very important to note, that, like,
Yeah.
even though you wouldn't lose your job if you're in a service industry in 2008, you there's a very high chance that you might have done, like, lost your job
Yeah.
in 2020.
I mean, that's really fascinating, and it sort of reminds me of a conversation that happens a lot in the Ghanaian political space now about, for instance, why things went bad maybe the past couple of years with inflation and all that. A lot of the time, the government's first instance is to point fingers to COVID, but none of them seem to be discussing in 2008 anything and then reference, oh, there was an economic crisis in 2008. Because it seems like as a country, there is no memory of it, which points to the fact that we probably didn't even feel that it was happening. It was very, very minor, very negligible. People didn't really get affected. But then when it comes to COVID, that directness means that everybody tends to suffer the consequences, which is really, really making sense of exactly what you are saying here. The second question I had on that take also was, you pointed out that different solutions were used and one solution wouldn't have worked for the other. So, for instance, they had to salvage the banks and not necessarily give money to people in 2008. In 2020, they have to give money to the people. Why is it that when you switch the position, because I think in 2008, some of the complaints or protests that came from the decision to give money to the banks was that the citizens were the ones who were struggling, so give the money to them instead, and not necessarily the banks who made the poor decisions. And so, why is it that if that approach had been taken in 2008, probably would have made things worse or not have been the best approach to solving the problem?
So I'll say this in a few parts. Number one, as to
Yeah,
why was that the prescribed solution in 2008, and why was it that happened? Obviously, as I said, a lot of people may agree, but also a lot of people may disagree with it as well. And
yeah,
then I'm going to talk about 2020, how it's different, and
yeah.
why maybe a more combined approach is required into 2020. For 2008, I think one of the biggest problems that happen whenever there is an actual financial crisis is that people make a run for the banks. And this has happened, like, in so many
Oh,
countries.
okay,
It has happened in
okay.
Argentina. It has also happened in places like Zimbabwe, right? Where, like,
Yeah,
when you have a financial crisis, people just go like,
panic
"Oh my God, the banks
withdrawals.
are going down. I better take out all my money from the ATM."
Yeah,
The problem with that is the point at which that happens and the banks don't have any money left. That's a massive issue. Number one, they won't be able to provide a lot of their other depositors with that money. That causes people to lose trust within the financial system and not like, and then put money under their pillow, essentially, and essentially not put it in the financial system. And
Yeah.
the banks generally may have to even declare bankruptcy. The problem there is banks are a very important part of our economy. Like whether you are a small business or a corporation, you need loans from banks, or you
Yeah.
need the help of a bank, for example, to execute an export or an import order from a different country, because banks are the financial institutions that execute these things. And these are just two of the very few things that I'm talking about. There's also like the credit cards, the debit cards. There's so many other functions
Yeah.
and values that banks generally stand for. And depending on the country, banks would loan out a portion of their deposits. So, for example, if a bank has 100 in deposits, some banks would loan out 80, some banks would loan out 85, depending on the country, depending on the regulations that exist.
Yeah.
And so, when you ask your bank for if every user today went to their bank and asked for their
Oh.
deposits back, they would not get it
Okay.
because they just
Okay.
don't have as much
Yeah.
liquid cash
Yeah.
at any given point in time. They have enough so that your basic needs would be fulfilled, like someone else's basic needs would be fulfilled, but not
Yeah.
like everyone's entirety of the savings. So in
Yeah.
2008 financial crisis, when people were panicked, when people were like, "Oh, okay, um, like AIG just went down, the insurance company, right?"
Yeah.
And then Lehman Brothers is going down, right? And then it's affecting the banks as well. If the government does not then and then declare that we're going to bail out the banks, or the fact that we're going to protect people's investments and savings and deposits,
Yeah.
you you could potentially see a bank run, which is far worse for the economy, right?
Oh, okay.
So you
Okay.
have to protect, you have to, in any way whatsoever, you have to make sure that there is no bank run. Now
Yeah.
note that in the United States of America, the government, the federal government, protects all of your deposits, however, only up to $125,000. So if you have
Okay.
$125,000 in the bank, entirety of your deposits are protected. Any extra penny on top of that, it's not protected by the law. However, the
Yeah.
government does have a vested interest to protect that as well, because otherwise you get a bank run.
Yeah.
So even though people may say, "Oh, we should have bailed out the people instead," the problem is the people are also affected by the financial system. So you kind of have to
Yeah.
save the financial system at that
Yeah.
point in time. We like the government has already failed in um, protecting and providing regulations that like prevent such calamities from happening. So
Yeah.
at that point in time, kind of have to look. You kind of have to not look back and look forward. But also at the same time, the government is also somewhat complicit. Like the United States government wanted a lot of people to have houses. That's why the bank
Yeah.
also ended up being so desperate. The banks ended up being desperate. The people generally were like, "Oh, we're getting favorable terms from the banks to buy a house. We're gonna buy a house." So there have been policies over years of the United States government that makes it easier for people to get houses, which is not necessarily a bad thing. Sure, you can want people to get houses. The problem becomes when people are getting houses um, at the expense of them not being able to repay those houses, and that leading to a crisis because there are too many houses in the market and not enough buyers. The housing price goes down, and then the banks do not have enough assets to salvage it. Actually, I have a simplifying economics workshop on YouTube if you want a bit more sort of detailed explanation of the housing
Yeah.
crash. That's not the subject matter discussion here.
Yeah.
However, I understand that the people were affected. There was unemployment caused by a lot of these problems, but the root problem there was the banking system. So you had to save the
Okay.
banking system first, and then put in
Yeah.
regulations such that it doesn't happen again, right? And I think the United States government, despite all the criticisms, did put in quite a few regulations such that does not happen going forward, which was
Yeah.
which was great, right?
Yeah. Yeah.
So those are the steps that you needed to take then. Coming to 2020 is a far different crisis, right? People are not spending money. They're not going out and spending money. They're not spending money in in one way or the other, and that's
Yeah.
affecting the economy. At that point in time, it's the people who don't have the money. Banks kind of still are fine with it because people are not really scared that their deposits are going to be lost in the bank. They're
Yeah.
not making a bank run, or there isn't a wholesale sort of, you know, um, panic within the
Yeah.
public that the banks are going down, I need to get my money, the banks are going down.
Yeah.
That's not happening in 2020. In 2020, rather, the problem is I cannot get my paycheck, or I just lost
Yeah.
my job,
Yeah.
or this thing that I want now costs twice because
Yeah.
the Chinese factory that was producing it just shut down, right? That was
Yeah.
the problem in 2020. So that's a different kind of a solution that you required. You required not just economic solutions, but healthcare based solutions as well, like
Yeah.
vaccine mandates, so that you give enough people vaccines so that they can go back to their jobs and start working again, or
Yeah.
the fact that you give vaccines to children so that they can go to school again, or you give vaccines to people so that they can go to shopping malls and buy things, so
Yeah.
that the economy can run again. You give people like COVID certificates so that they can travel and go to a hotel and
Yeah.
participate in tourism and get the economy up and running again.
Yeah.
So many different facets of solutions that
Yeah.
combine not just economics but also like healthcare, education, and
Yeah.
so many other facets of policy making, that
Yeah.
2020 is a unique and a very different circumstance.
That's really interesting. So if I'm getting this right, just to sum up the two different unique circumstances, in 2008 is more of a trust problem with the financial institutions, and so the solution has to aim to restore trust and let people feel safe with their monies being there to reduce panic withdrawals. For 2020 with COVID, it's more of purchasing power problems where people either do not have the money to interact with the economy, or for healthcare reasons, they cannot even step out to interact with the economy. Therefore, it's more of you need to open the purchasing power lines so that people can interact. That's such a better way of understanding these two financial crises. But yeah, really, really interesting stuff. Um, let's move on to COVID, because I mean, I didn't live in, okay, I was alive in 2008, but I'm not sure I recognized anything that was happening at the time. I was young, but also, I mean, in Ghana, like you said, in Bangladesh, so I'm not even sure that a lot of the old guys in the country really recognized that something huge was happening in the world at the time. But COVID, we all went into COVID with a certain functionality of the world that was set up and we thought was probably perpetual. We came out of COVID and it seemed like we had walked through a tunnel from a very dark end, and then we've come to see an entirely new, it's like walking from a village, and then after you go through a tunnel, you go and see these skyscrapers and big city buildings and all that. And it's like everything and a lot of things look different. Because I mean, maybe we've not started to really conceptualize or accept how different things look. But if you sit and try think about it, 2019 post COVID, 2021, there's a whole lot of things that are going on different. And one of them is not just based on employment and work culture and all that, but also I think we as people have sort of felt certain structural changes in the way in which the economy works. Some people say the reason why inflation is difficult to deal with is because the kind of inflation we are facing is probably different. And so raising interest rates are not solving the problem. And so the question I want to ask is, what seismic shifts did we see in the world economy post COVID? And how are they affecting the everyday person in the way in which they interact with the economy?
There's so many seismic shifts that have happened during COVID, but also post COVID as well, that affect
Yeah.
people's lives. I think the number one problem that initially we faced was a supply chain crisis, right? We
Okay.
just didn't have either things being produced or things being moved. And for
Yeah.
the world economy to function, these two things are very important. You produce stuff and then you move stuff. Like,
Yeah.
there's this meme that goes around in the internet that was just like, in the US, you get pears that were picked in Argentina, packaged in
Yeah.
Thailand, and then went back to the United States of America.
Yeah.
But even though that sounds absolutely wild, but that's exactly how the global economy works. Like, you may
Yeah.
find that wild. At the same time, when it comes to this phone was made in so many different countries. So many different parts of this phone was made in so many different
Yeah.
countries, right? It's Samsung. So a part
Yeah.
of it was made in Korea. The chip came from Taiwan, and
Yeah.
there's so many aspects of this production process as well. The point at which these things got disrupted, right? Maybe not a lot of the tech products. However,
Yeah.
say things like you don't produce enough clothes anymore because the
Yeah.
factories had to be shut down because you cannot, like, factories, clothing factories at least, are not well spaced, right?
Yeah.
People will have
Very
to like
small. Yeah.
stay like within say a meter of each other
Yeah.
in
Yeah.
certain supply, like assembly lines and other portions of the manufacturing process, that it makes it very difficult for you to execute it, right?
Yeah.
So there has been a supply chain crisis where there were certain things that were not being produced, but even if they were being produced, the ships were just not leaving from port to port because some countries decided to entirely shut down the border. They're like, oh, we won't have airlines coming in. It doesn't matter if it's a cargo carrying
Yeah.
airlines, we'll just not have it. Or we won't have ships coming in. So ships couldn't be, you know, managed or pushed to the destination where you wanted to send your goods to. So it was a very
Yeah.
unique crisis in terms of that, where people didn't produce things, people also were not buying a lot of things, because at the same time in COVID you will realize you're not going to the movies. If you're not going to
Yeah.
the movies, how is the movie theater owner paying that particular person who sells popcorn in the movie theater, right? It's as
Yeah.
simple as that. And that becomes very difficult question. And if that person is laid off, how are they running their family? How are they paying rent? And that becomes
Yeah.
that becomes a problem. And these micro sort of unemployment instances, when they add up and they multiply, they create a huge problem. And that has a seismic effect within the economy, where the economic activity is not enough for us to keep
Yeah.
at pace with the previous levels. There's unemployment rise, etc. At the
Yeah.
same time, you also have inflation, right? This is a big problem because in 2008 financial crisis, there was a financial crisis. People were
Yeah.
losing faith in the system. They were not spending as much. Inflation rates were not going up, they were going down because
Oh.
people are not spending as much, they're not demanding stuff.
Yeah. That's true.
Here people are not demanding stuff, sure, but you're also not producing things, so the price of
Yeah.
goods are increased anyways, because there's still
Yeah.
demand for some things. Like for
Yeah.
example, if there aren't enough clothes in H&M, but people realize that maybe in the western countries people still want to buy some clothes, whether it be online or not, they can still charge a premium for their clothes even if there
Yeah.
aren't enough supply for clothes, so the price of the
Yeah.
clothes go up. And this is
Yeah.
true for a lot of products where the prices
Food.
have to go up because there's
Yeah.
just a limited supply of it. Like if there are 10 people wanting phones but you only have 5 phones in the market, there's going to be a bidding war and it's going to increase the
Yeah.
price of phones. And that is a problem where, or you have an economic crisis, but usually economic crisis lowers the price of goods because people don't demand as much.
Oh.
And then
Yeah.
and then people aren't spending enough. But here there are enough people to be able to spend with their savings or whatever
Yeah.
credit card that they have, but you don't have enough goods, so prices are going up as well. So it's a double-edged sword. What do? You cannot
Yeah.
increase interest rates to solve the inflation problems as much, because you also want to increase economic activity. Inflation
Yeah.
went up, economic activity went down. If you increase interest rates, inflation may go down because that decreases
Yeah.
demand for things. Very simply put, if you raise interest rates, then I'm going to be like, hey, I don't want to use my credit card anymore because I'm going to have to
Yeah.
pay so much more next month. So I just won't buy that
Yeah.
extra laptop, or I would just won't buy that extra gadget that I thought I wanted but I can't afford it anymore.
Yeah.
That's a problem that happens due to high interest rate. So
Okay.
that's why that pushes down the prices of goods, because then the seller cannot sell it anymore and they'll have to push down some of the prices. And that's how
Yeah.
prices stabilize in certain instances. However, the government doesn't want that to happen. The government's like, you haven't been buying as much
Yeah.
in the
Exactly.
last few years, and therefore we want you to buy stuff so that people can get their employment back. We want you to go to
Yeah.
that hotel and spend some time so that the waiters and the service people in that hotel get their jobs back, right? So
Yeah.
you can't really raise your interest rates to combat inflation in that
Yeah.
scenario where you're also wanting to increase economic activity. So this is
Yeah.
a double-edged problem that requires a lot more nuanced instruments to tackle.
Yeah.
So as we saw in the US, for example, they did initially just give cash to people so that they can have increased demand. Now going forward, they're slowly looking into interest rates more, because now you
Yeah.
don't have that supply chain crisis anymore, because that has been somewhat, at least somewhat, solved, because we're back to normalcy
Yeah.
again.
Yeah.
But also the other seismic shift that happened in supply chain as well is that people realize that maybe we shouldn't globalize things as much anymore. Like if we're relying more on other countries and we have a
Yeah.
problem like COVID, we're kind of in the ditch here, because
Yeah.
if Taiwan cannot send us goods because of a crisis that's happening in the world, whether it be disease and everything, then we cannot produce this good. Maybe we should produce this good either here or we should
Yeah.
incentivize another country that is very near us. Maybe
Yeah.
like if you're in the US, maybe let's incentivize Mexico to produce that good. So you have
Yeah.
more localization, regionalization happening. That is also a
Oh.
different kind of a seismic shift in the economy, right?
Yeah.
So when you have an inflation problem, you kind of have to do it in stages. Be like, let's solve the economic activity problem first, then let's solve the inflation problem. Because if you want
Yeah.
to solve the inflation problem now, we make the economic activity problem worse, right? And you don't want to do that. So like it's one of the most complicated sort of policy problem that has
Yeah.
occurred in ages, because of the way in which the global economic system has been so very complicated. And it's not just, I'm just talking about a few things. There's so many impacts
Yeah.
that are there. Like there's an
Yeah.
impact on currency reserves of countries, there's an
Yeah.
impact on their currency values as well because of currency
Yeah.
reserves, and that that hurts a lot of these issues. But also at the same time, you have something like the Ukraine war
Yeah.
also affecting things, because Ukraine produces the grains for a lot
Yeah.
of countries. Like Ukraine supplies the principal food for a lot of countries. So
Yeah.
once that, like, your first concern isn't exporting stuff when you have a war in your country, and that affects the
Yeah.
world economy, and that affects
Yeah.
a lot of problems. So a lot of the products that Ukraine used to produce went up in prices because Ukraine wasn't supplying them anymore, and that's
Yeah.
completely divorced from the COVID crisis, right?
Yeah.
So you have a very complicated problem that requires like a lot of understanding and nuance to be able to solve.
Look, to be very honest, I haven't understood the complexities of COVID and post-COVID crisis to this detail up until this point. Because obviously, like we do some readings of maybe one article somewhere about what inflation is happening, but I don't think a lot of us who are even talking about these things truly understand the nuances and the different stages. Because I've heard several people speak, and not once have I heard them talk about inflation that happens in this nuanced way that needs more of contradicting solutions. Therefore, you need to phase the solutions in at different stages, as in of that recovery cycle. And so it's really, really informative. This specific answer that you've just given. I mean, it's quite interesting. You spend a little bit of time on inflation as well, because that's like the next question I wanted to ask. And maybe what I would focus on here is to ask whether or not inflation is always a bad thing, because almost always when I hear about inflation is negated in some sense and is said to be a bad thing. But if you look at it, maybe there's some end of the population who are benefiting from inflated prices, like let's see, sellers, people who are dealing in these things, and the retailers. But for the consumers, it's bad. If you look at low prices, maybe consumers are excited about it, but probably retailers are not that excited about lower prices and all that. So is inflation always a bad thing? And if not, what are the specific instances where you would want to deliberately induce inflation to yield positive outcomes?
In a lot of cases, low or a controlled amount of inflation is actually
Yeah.
a great thing. Like
Okay.
usually there is an inflation target that economies have. Like for the US economy, the inflation target was 2% for a while, for
Yeah.
a few years. I don't remember the exact figures, but the idea behind this concept is very simple, which is that inflation is caused when prices rise, right?
Yeah.
Prices will rise if people's income rise, and you want
Okay.
people's income to rise. In a healthy
Okay.
economy, you want people's incomes to rise. What do I mean by
Yeah.
this, and how does it happen? um, Say in supermarkets, if there are say 10 to 15 employees in any supermarket that
Yeah.
are there, people after working for a year will be like, we demand that our wages grow, right? They'll
Yeah.
demand
Yeah.
that their wages grow. If they
True.
demand that their wages grow, then the supermarket chain is going to be like, we need to increase the prices of products at least a bit so that we can compensate for their pay wages growing, because they don't want to dip into their profits in order to pay
Yeah.
for those increased wages, right?
Yeah.
So that will cause a rise in price and a rise in wages at the same time, which will in turn also
Oh.
cause inflation. But is
Okay.
that necessarily a bad thing? Not always, but it can sometimes be. There are two scenarios here. One, where the wages and the inflation pretty much match, right? where,
Okay.
okay,
Okay.
our wages have risen, but inflation has also risen very similarly. So your
Yeah.
quality of life is very similar.
Yeah.
At the same time, for some people, obviously this doesn't apply to everyone. For some people, they will earn more than inflation. Like either they get a
Yeah.
promotion or their business has done really, really well, so the owner feels generous. So they will earn more than inflation. So their quality of life has risen. So your costs have
Yeah.
risen by 3 to 4%, but your salary has risen by 10%. Your standard of living has increased.
Yeah.
The other end of the spectrum is inflation has happened 3 to 4%, but your salaries have either not increased or increased by 1 to 2%. So your
Yeah.
standard of living has actually gone down. So
Oh,
as you can
okay.
see, this last scenario is not wanted.
Yeah.
It's not something that is ideal. However,
Yeah.
another scenario where the wages grow by more than the inflation rate, that's actually good for the economy, where people are earning more now, even though there is some inflation. People's
Yeah.
incomes are outpacing that inflation. That's a great thing. Sometimes it can
Yeah.
happen because you're earning a lot of money from abroad because you've exported a lot of stuff
Yeah.
that has helped your economy overall. It can happen in a lot of countries because a lot of remittances come in. So for example,
Yeah.
a lot of people from India go work in the Middle East and send a lot of money back. And
Yeah.
this money that is sent back, the people who get that money are going to spend that money. And when they spend that money,
Yeah.
then small businesses or people who just earn from like sales commissions, etc., will earn more money because of that,
Yeah.
which in turn helps the economy, right? And those things cause inflation as well, because now that people have more money, they're going to want more things, they're going to demand
Yeah.
these things even more. So at that point in time, you're going to cause some form of inflation. So inflation isn't necessarily a bad thing. It is, however, a bad thing when it goes up to the stage at which the wage growth cannot keep up with it. So the inflation
Yeah.
happens by 3 to 4% because of COVID, but the business owner cannot afford to give you a
Oh.
wage rise. In fact, they
Yeah.
may even decrease your wage because of the COVID-19 crisis, right?
Yeah.
Then inflation is a
Becomes a
bad thing.
problem. Yeah.
It
Yeah.
becomes
Yeah.
a massive problem at that point in time. So,
Okay.
and this is something that has happened even in places like the US, where inflation has gone up, where the price of things, etc., have gone up. And real wage has kept up with that inflation in one way or the other. However, the problem that happened is that the profits have increased for businesses by so much that even though
Okay.
the wage rate has somewhat kept up with inflation in one way or the other, most of the profits of that increase in prices went to business owners. So people's
Oh,
standard of living
okay.
has actually gone down. So
Okay. Okay.
if the for example, if the minimum wage is $7 in 2009 and it's the same minimum wage in 2022, that's not good, right? Because
Yeah.
obviously prices of things have increased. So the life that they could afford with the minimum wage in 2008 is not the same as the life they can afford with the minimum wage in 2022. That's
Yeah.
vastly different. And that's why we always see in, like, in discussions being like, raise the minimum wage, raise the minimum wage. Why?
Yeah.
Because minimum wage needs to keep up with the prices that are there. So inflation, that's the reason why inflation has been such a nasty sort of negative word, is because
Yeah.
when inflation happens, people realize that they're losing money, they're not earning money, they're losing money. If inflation was synonymous to,
Yeah.
oh, inflation happened, but actually, you know what, my wage has increased by more than that, people would be happy about inflation. But the
Yeah.
reality is that in a lot of countries, inflation comes with, oh my god, inflation happened here for 6%, but my salary growth was only 1% or 2%. In fact, in
Yeah.
so many other countries where, because of data issues or because the government is undemocratic and hiding information,
Yeah.
the real inflation will be 15%. On paper, they'll show that the inflation was 6%. And that is the rate that is used by businesses to increase their employees' wages, right? They're going to be like, hey, the
Yeah.
official inflation is 6%. I'm raising your wages by 6%.
Ooh,
But the
okay.
actual inflation is 15%. So who's losing money? It's the workers that are losing money then.
Yeah. Yeah.
That's why they get so, like, mad and angry about inflation. I think that's very
Yeah.
justifiable as well in that particular case. So there are
Yeah.
different scenarios. If it was that your wage outpaced inflation, you would be a very happy person. If it didn't, then
Yeah.
no, you'd be a
I
sad
mean,
person and lose money.
this is true. I think somewhere last year in Ghana, or this is last year, last 2 years in Ghana, inflation was somewhere around 50, 60%, and everybody was complaining because every single day the price of goods were changing just upwards. And you're like, look, my wages hasn't increased in 3 years because we are just coming out of COVID. I'm even lucky to be having a job because majority of people have been laid off, and now prices of things are just increasing to the point where my expenses for a month has now tripled and my wages is still the same. right? So I mean, it's really interesting. But how do countries deal with inflation? Because if it's such a negative thing, a lot of the time it becomes a voting issue for most governments in terms of assessing their performance and then people voting for them. In Ghana, for instance, it's a heavily politicized tool, especially I think the last two election cycles, the current vice president held several lectures talking about inflation and currency value and how it's a determinant for poor economic policies. And today, inflation is double figures in the country. So, I mean, it's another hot topic. How should countries deal with it? We've heard that they deal with it by raising interest rates, which you've just explained. But is that the only way they deal with it? And if there are other ways and nuances to interact with it, what different variations of inflation should we see them applying? What specific tools?
So the policy tools that you have to combat inflation is very, very context dependent. By that
Okay.
I mean, if it is that the reason inflation is happening is because factory production is low, the
Yeah.
first response to that should be let's get people onto the factory floors and get them producing stuff. Because
Yeah.
simply speaking, if there are not enough loaves of bread in the market, the price of bread is going to go up. You
Yeah.
supply it with more than enough loaves of bread in the market, then people are going to,
Yeah.
then producers are going to have to reduce the prices. They'll still make money because they're still making a profit on it, and
Yeah.
and then that's going to stabilize the prices, right?
Yeah.
That, however, is a very sort of unique inflation problem.
Yeah.
Usually people don't view that as the solution to inflation when they think about inflation,
Yeah. Yeah.
because usually people think of inflation as a demand pull inflation, right? Which is that
Yeah.
it's happening because of it's happening
People
because
spending too
of
much.
higher demand of things. Like people are
Yeah.
demanding things more than the supply, and it's caused mostly on the demand end, which is not necessarily a bad thing in a lot of cases. Like
Yeah.
usually the reason demand is stronger is because people have more incomes, right?
Yeah.
um However, this is a unique situation where it was a supply side inflation. It's rather like the more fancy term for it is a cost push inflation, but actually it's just a supply side inflation, right? Which is that the reason the inflation has happened is because of problems in the supply chain, just
Yeah.
overall production process. So we need to make sure that we solve it. So the solution to inflation might actually be a vaccine in certain
Okay.
circumstances.
Yeah.
However, the problem with that is, and now I'll explain to you the problem with that. I'm
Yeah.
oversimplifying it, because what happened in a lot of countries is the production then crept up, the production went back up again, but
Yeah.
producers just decided not to decrease the prices anymore, right? Why will I
Oh.
sell something for
Okay.
$1.5 if I am used to the normal of selling it for 2.5 $3, right?
Okay.
Why will I do that?
Okay.
Why will I go back to
Okay.
previous prices when I'm making money with the current prices? And guess what?
Yeah.
The consumers are also used to the same prices, right?
Yeah.
At that point in time, there is a way that you have to sort of force their hand to bring prices down, or do something or the other to bring prices down. Now, there are a few tools
Yeah.
that are conventionally known as solutions to inflation.
Yeah.
Number one is obviously raising interest rates, as I explained. When you raise interest rates, people don't demand those things anymore because they just can't afford to do it. Their mortgages have
Yeah.
just gone up, or their credit card interest rates have just gone up. Therefore, they're not able to buy things at the rate that they were able to buy before. Therefore, producers are forced their hand to sort of reduce the prices. That controls the inflation, right?
Yeah.
That's just a simple way of, like, raising interest rates. The second
Okay.
one is actually something that is wildly unpopular, and that's where therefore it's not used, which is raising taxes. You raise taxes,
Oh.
people's purchasing
Okay.
power goes down, and that's how you control
Okay.
inflation somewhat, because then people don't demand those things anymore.
Okay.
But it's wildly unpopular. Like, people
Yeah.
generally look at this and be like, "Nah, we don't want to do that. So we don't want to, like, sort of um,
Okay.
we don't want to
Okay.
give more taxes to the government," and
Yeah.
that can be a problem. There are
Yeah.
other ways. For example, government can reduce spending. Government can just stop spending on things that reduces the prices. So when the government reduces spending, they create fewer jobs. They're not being able to pay their government workers as much, even though that's unlikely to happen. However,
Yeah.
the government is not creating enough projects for the private sector to make money off of, because a lot of private
Yeah.
sector companies as well like depend on government contracts, etc. So when they reduce
Yeah.
government spending, it has an effect on overall the economy and reduces the impact of things. They can
Yeah.
also sort of increase things like reserve requirements for banks. So remember, I said if the bank has $100, they're able to loan
Oh,
out 80.
yeah.
If the
Yeah.
government says no, you have to keep $40 when you have 100, you have to
Okay.
keep it. Then the bank can
Yeah.
only loan out 60. So there's
Yeah.
less money within the system. There's less money on the hands of the people. That also reduces
Okay.
inflation as well. There's like a whole host of things um,
Wow.
that that you can do in order
Yeah.
to reduce inflation. It just depends on, like, sometimes you use a combination of it. Sometimes you just,
Yeah.
like, use one or the other,
Yeah.
um, and then
We
you can
almost,
sort of see the
yeah,
variety of it.
we almost always only hear about increasing interest rates. Trust me, it's like anytime you hear about inflation and governments trying to, and even this is not just like from maybe things I've heard within the debate space, even mainstream media. Every time the concept of inflation comes up, a lot of the response suggestions, or when is the central bank going to increase interest rates? Why are they waiting so long to increase interest rates? I don't think a lot of people really understand the different solution mechanisms that you've just pointed out. And also the fact that sometimes the solution to inflation might not even be an action that the central bank has to take, but more of maybe a specific inducing effect that the government has to make to increase maybe production if it's a supply side inflation that's been caused. One fascinating thing I found, which shocked me a lot, was like when employment goes up, inflation goes up. And if unemployment happens or increases, inflation comes down. And I'm like, yo, the system is rigged because how is this supposed to work? Because governments have been voted, like unemployment is an election issue, inflation is an election issue. If unemployment is high, people are concerned. If inflation is high, people are concerned. And all of a sudden, I find out that if you increase employment, you increase inflation, and if you decrease if you decrease employment, you decrease inflation. How do governments balance this out?
So they kind of have to balance it out, right?
Yeah.
In one way or the other, they have to kind of make sure that they balance it and they don't overdo either of them. You can probably get perfect employment that would cause a lot of inflation. That's probably kind of very, very difficult, but you could
Yeah.
potentially do that. At the same time, it can also be that you get zero inflation, but then you have a lot of unemployment, because the reason why prices aren't going up is because people can't afford to buy those. So that's why you can't.
Wow.
Yeah. So obviously the government needs to balance both, but there are some ways in which you can mitigate these problems, right? Like, for example, if you have a healthy level of unemployment, you can usually manage it with unemployment benefits. If you don't have unemployment to that level. At the same time, if you
Yeah.
have inflation manageable as well, at a managed pace, then you can essentially keep interest rates at a rate such that, like, it manages inflation somewhat, but it's not too high so that it gets out of reach for the people to buy
Okay.
things like homes and all of that. So it's a combination of so many factors when it comes to inflation. And there's this famous, like, the
Yeah.
Phillips curve, where the sort of relationship between inflation and unemployment.
Yeah.
Most people who don't study economics doesn't really need it. But yeah, when I looked at the Phillips curve as well, I was just like, yeah, that kind of looks like it is a bit difficult in general in
Yeah.
terms of maintaining. um However, it's kind of necessary at that point in time to also understand that the reason this is happening is because you need a balance when it comes to the demand and
Yeah.
supply side of things. And when one
Yeah.
goes erratic, then you kind of have to control it, and that's why you have
Yeah.
these
Yeah.
combinations, and it is possible to do that. Like, there are solutions to the whole inflation problem that doesn't really affect unemployment as badly as other things. So, for example, oftentimes the reason you have inflation is because your imports are more expensive, right? It's because,
Oh,
like,
yeah.
you are an
Yeah.
import
Yeah.
dependent
Yeah.
economy and your imports are very expensive. If the government takes strategic steps to maybe increase the value of their currency, which also obviously comes with some costs, because when you increase the value
Yeah.
of your currency, then your exports also get, your exports get more expensive. That can hurt your exports. However, if you
Yeah.
think, no, that is the solution that we're going for, maybe not excessively, but at least somewhat, so that we can at least control inflation to a certain extent, you may get away with not causing as much unemployment. because
Yeah.
if you increase the value of your currency by too much, then your export industries will have unemployment crisis, right?
Yeah.
Do you see how this is going? Even with something like currency valuation that is affecting inflation, it's a double-edged sword. If you increase the price
Yeah.
of your currency by too much by buying currency off of the market
Yeah.
and increasing the demand of it, then your import prices go down. Sure, your imports are cheaper and therefore inflation goes down. But what's affected
Yeah.
is your export industries, where you get unemployment, because if the
Yeah.
export industries are not making money, they're going to have to lay off people, right?
Yeah.
So even though these are things that people usually explain through like interest rates, even with a solution such as a currency manipulation, you have this trade-off. And that
Yeah.
trade-off, this trade-off will always exist. Like this is like if modern economics, or unless we discover a different economic system, this trade-off will exist.
Yeah. The system is just rigged at this point. That's it. Because, I mean, if you look at it, it's more like understanding and accepting that at every point in time, maybe a certain level of unemployment is good for the economy, because you need to moderate demand levels and not like inject it with steroids to just keep on rampaging up and up and up, right? And the much more painful thing I find in all this is how connected they are in reality, yet how disconnected they are in public discourse. Because when you have politicians speaking about inflation, when you have them speaking about unemployment, they are almost always exclusively independent topics of discussion, and never are they had as systems that interact with each other. And therefore, we should let people understand that, look, these are some of the trade-offs we make for economic purposes. And so we should understand the holistic nature of the issue. Because up until I was reading on this episode and then went to chance on that whole Phillips curve, I never knew. So in my head, yeah, every country should strive to improve unemployment rates as much as, if you can get zero unemployment rates, that's perfect. And then I find out, I'm like, wait, why don't public officials speak about these things this way, right? Because obviously we citizens need to understand the nuances and the relationships between these things. And a lot of the time, we almost always never get to understand them properly. Also, another value of this episode, by the way, really interesting stuff that I'm learning, but getting more explanations too. Again, this episode has been so nice because almost all the time, before I move on to another question you'd have touched on in the previous question. So my next question line is really on currency values, which you just mentioned in discussing the solution to inflation, which is more of like, I've heard people say currency values are dictated by certain complex currency interactions sometimes, which currency you are pegging. I still don't understand what pegging means. I've heard it a lot of the time, which currency you are pegging your local currencies to. Sometimes I also know the influence of the US dollar on a lot of other currencies, such that if the US dollar keeps growing stronger today, the Ghanaian currency will just start getting devalued because the US currency is growing. But you look at other countries like China, who deliberately manipulate their currency value as well. And then I ask, how do they get to do that? Why is it that when the US currency value is going up, they get to say, no, mine should come down instead? And so I want to understand the nuances in currency valuation. What exactly determines the value of a currency? What do these different parts play in that value determination? And why is it that some countries can still get to manipulate their currencies independent of whatever maybe majority of the world have to experience?
Right. So obviously, currency devaluation is a massive topic on its own. Like, I can spend a lot of time discussing them, but I'll try to summarize
Yeah,
my understanding of the scenarios, so that people understand it. I think the first thing that people need to
yeah,
realize is that the dollar is used as a standard, for everything. By that I mean that when
okay,
I'm converting, say, the Indian rupee to the Omani rial, right?
yeah,
It's not a direct conversion between Indian rupee to Omani rial. It's the Omani rial's value
okay.
relative to dollar, Indian rupee's value relative to dollar. That's the value that you
Oh,
determine, and that's how you sort of convert the two
okay,
currencies, because the
okay,
dollar
okay.
is the standard. So at the same
Yeah,
time, when you say, sure, if the dollar appreciates, then the Indian rupee value and the Omani rial value can both go down, right? They can both go down in those circumstances.
yeah,
However, given the fact that um, they both went down, their relative value doesn't change. because it's the change in the dollar that happened. Their relative value doesn't change, so it doesn't affect maybe their
Oh,
trade
okay.
as much.
Okay.
But
Okay.
it does affect currencies that are directly related to the dollar more. So, for example, if you're trading a lot with the US,
Wow.
then your
Yeah.
trades will be affected quite a lot because the value of the US currency went up. At the same time, um, it can also affect India and Oman, for example, because
Yeah.
sometimes it's also directly related to the amount of foreign currency reserves that you have. So if the dollar price goes
Yeah.
up and your import goes up because of that, then maybe you don't have as many foreign currency reserves as you needed, and that's why your currency gets devalued. So there are indirect effects.
Okay.
In theory, though, it shouldn't affect
Okay.
anything because the US dollar prices change, but the US dollar prices changing
Yeah.
affects a lot of other factors that in turn affects your trade in general. So
Yeah.
it's a lot of complicated back and forth that happens. In general, though, most countries in the world have a floating currency. They don't really peg it. By that I mean their currency value is determined by the market. What's the demand of the currency? What's the supply of the currency? Therefore, you have
Yeah.
a sort of demand and supply curve, and that's how you generally determine the value of that currency, at least within the open market. At the same time, for China, for example, China uses certain manipulation tactics to keep its price in a particular way. There are countries
Yeah.
that directly peg their currency, be like, my currency is worth this much by dollars. The problem
Yeah.
with pegging in a lot of cases that happens is that your currency may be worth a very different value in the open market. And at that point in time,
Oh, okay.
um, the pegged value does not really reflect, like for example, if the
Okay.
value of that particular currency is higher in unofficial channels and then in official channels, then there are sellers and buyers, whoever it benefits, are going to go to the unofficial channel and not go to the official channel at all,
Yeah.
which affects the official channel, and the government will have to prop up that currency in artificial ways, be like, oh, now we have to spend more dollars from our reserves, and now our reserves
Yeah.
are going down. If the reserves are going down, we cannot use those reserves to buy things like imports, etc., which affects a lot of things. But
Yeah.
I'll try to summarize and simplify it in a way such that you can understand. Generally speaking, for a
Yeah.
country, they have their own currency. If it devalues, then usually the exports have an advantage because exports get cheaper because the exporters are still paying wages
Okay.
in the local currency, right?
Yeah.
The local currency and the wages don't keep up as much. So the exporters
Yeah.
have an advantage because now the cloth from Bangladesh is worth what, 50 cents, because the Bangladeshi currency has
Yeah.
devalued. Even though it used to be 60 cents, now it's 50 cents because the value is in the Bangladeshi taka,
Yeah.
right?
Yeah.
If the currency goes up in value, then it's the exporters that get a disadvantage because that 60-cent cloth is now worth 70 cents, and that's a problem
Yeah.
for them because people won't
Yeah.
want to buy from Bangladesh. Then people are going to be like, oh, we want to
Yeah.
buy from Cambodia, we want to buy from Vietnam.
Yeah. Yeah.
The flip side of this is that if the currency value goes up, then imports are easier. So now Bangladesh can spend fewer amount of money getting say imports from India, like dairy imports from
Yeah.
India, or agricultural imports from other places, or technological imports from places like South Korea, US, China, etc. So usually it's just winners and losers when it comes to currency devaluing and currency going up and down. One of the biggest things
Yeah.
here is the reserve. The reason the
Yeah.
reserve is there is because the Bangladesh government has a reserve, which is like an amount of USD that it has, just as
Yeah.
like let's just think of it as a savings account. The reason it has a
Yeah.
reserve is because they earn USD from exports, and people send USD
Okay.
through remittances from other countries, but
Yeah.
also they get USD from other sources. So, for example, when I was like, if you look at, for example, institutions like the IMF or the World Bank that gives
Yeah.
loans in US dollars, they get the US
Yeah.
dollars from there as well, and they
Yeah.
build their reserve through that.
Okay.
The reserve is something that allows a country to survive even when things go bad. Like, even if
Oh,
Bangladesh
okay.
cannot export anything today, they can still survive with those reserves for the next 2 months because they can buy, say, imports. I'm making this up, by the way. It's not a real statistic. The number might be
Yeah.
different. Some countries have reserves for 15 days. Some countries have reserves for years. Some countries have reserves for like
Yeah.
2 months, 3 months, whatever the standard
Yeah.
is. When the reserve gets depleted because of one reason or the other, the problem that happens because of those reserves is the fact that there is a direct impact on the currency. By that, I mean, if the reserves go down, your currency value also goes down because there are
Goes
fewer
down.
US
Yeah.
dollars against an amount of currency that you have. If your reserves go up, then your currency value also goes up because the amount of USD against your currency is higher, right? So the
Yeah.
reserves also matter quite a lot for the people and like for the overall economy in general, like just the functioning of the
Yeah.
overall economy. So you have the reserves as well. And this is like generally when it comes to like any, like even when it comes to the Ghanaian currency, for example, like a lot
Yeah.
depends on your reserves. Therefore you'll see that sometimes in the newspaper they'll say, oh, the reserves have gone down or the reserves have gone up. And
Yeah.
oftentimes the governments will be like, hey, people living abroad, can you please send remittances so that we can have an increase in our reserves?
Yeah.
That's why people,
Yeah.
like governments, plead and give incentives to expatriates to send remittances, and not send remittances through like shady channels, like the channels that don't involve the government.
Yeah.
Like send your remittances through the bank so that we can get the US dollar. Send your
Yeah.
remittances to government channels so that we can get the US dollars. We'll give you 2.5%. We'll give you 3% incentive. Whatever it is, we'll give you an incentive
Yeah.
to send us, right?
Yeah.
So that happens quite a lot. So that's just generally how currencies function. Then there are currencies like the Chinese yuan, which are very complicated
Yeah.
and very different. The Chinese yuan is the only currency in the world, or maybe not the only currency in the world, but like it's known for this. It's the currency in the
Yeah.
world that's known for simultaneously being overvalued and undervalued at the same time. Um, I'll explain.
How is this
And
possible? Yeah.
why? Then the question is, why is it undervalued? It's undervalued because they
Yeah.
want to keep it undervalued so that their exports are competitive, so that things that produced in
Okay.
China are not as expensive, they're cheaper, right? They're easier for Western
Okay.
countries to buy, they're cheaper. So that's why they want the it to be undervalued, right? That's
Yeah.
understandable, that's fine. um they want to keep it like artificially deflated because of that, artificially sort of reduced in terms of price. Why is it
Yeah.
then overvalued at the same time? It's overvalued because there are so many restrictions in China that does not allow its citizens to spend money willy-nilly on foreign currencies. What do I mean by this?
Oh.
You cannot just send all the money you want abroad from China if you want to.
Okay.
There are capital restrictions on it. You need to go to a
Yeah.
bank, you need to get it
Yeah.
approved,
Yeah.
yada yada yada. You cannot just carry Chinese currency on your pocket and walk out, or like
Yeah.
buy, say, more US dollars. There's a limit up to which you can buy US dollars. There's a limit up to which you
Yeah.
can send US dollars abroad, converting your Chinese currency. So there is actually a lot more demand for other currencies in China
Okay.
that China wants to
Okay.
keep artificially
The
low through
supply. Yeah.
restrictions and through regulation.
Yeah.
That
Yeah.
makes it overvalued, because otherwise people would flood the market with the Chinese currency by buying all these
Yeah.
other currencies, and that would reduce their
Yeah.
prices because more demand, like more supply, and the demand stays the same but supply goes up, price goes up down, right?
Yeah. Yeah.
um
Yeah.
so that's why it's undervalued. So that's why it's
Oh.
overvalued, right? So
Overvalued.
that's why the
Yeah.
Chinese currency is known as both undervalued and overvalued at the same time. And that is very complicated. I was just like, but that makes sense, but at the same time, then which power is greater? Is the undervalue greater than the overvalue? That is
Yeah.
something that people then discuss on, then debate on. And okay,
Yeah.
if it's simultaneously undervalued and overvalued at the same time, does it mean it's just valued right? It actually isn't, because the overvaluing is also something that is speculative. The undervaluing also something that is
Yeah.
somewhat speculative, not entirely. The undervaluing is not
Yeah.
entirely speculative. The
Yeah.
overvalue is somewhat speculative because you don't really know the real
Yeah.
supply or the real demand of the currency because of these restrictions. So you don't know how much overvalued it
Yeah.
is. At the same time,
Yeah.
you don't know how much undervalued it is because you don't know how much overvalued it is. And
Yeah.
it's a whole problem in that case. Yeah.
Wow. Okay, I should have. I mean, it's good that this is a recorded episode because I get to watch it anytime I need an accounts an accounts breakdown. But this is like super like clear explanation exactly of how these things happen. Because, and I mean, this makes more sense to me now of something like we are debaters. In the past years we've come to do a lot of online debate competition. Sometimes you judge a competition in China online, and then they'll tell you, look, it would have to take maybe 2-3 weeks or a month before we can send out all payments, because they are doing payments, obviously exporting the currency in USD to reflect at your end. But then they always say, oh, there's this daily limit, there's this weekly limit. And I think as a person, I'm sitting here, I'm like, yeah, sure. I mean, you've told me there's a limit. I don't really care the implications of it. I've never thought about exactly why those things are there. But now listening to you explain it, it's probably even makes me understand this has been in my face all the time, and I probably exactly didn't understand how it was happening and why it was going that way, which is really interesting as well. Because I was about to ask, was the mechanism of devaluing it, for instance, just reducing their reserves of USD? Because you mentioned that if reserves go down, then the value go down. But then the added mechanism of restrictions and the limited nature of the spending or the ability to buy foreign currency also makes it a lot more interesting as well. Wow. Anyway, final question though is, what are the most if someone should discuss a country, right, or should try and look at the economic situation of a country, what do economists look at as the most significant indicators of either growth or bad performance of an economy, and why do we pick those indicators?
This is again a very highly debated issue because generally speaking, the conventional ways of measuring economic growth is what GDP.
GDP, yeah.
Um, yeah, I generally like to look at GDP per capita, obviously more than GDP, because India's GDP is huge, but it has
Yeah,
like 1.4 billion people. I don't know if it's 1.3 or 1.4. Like it has above a billion people. Obviously, its GDP
yeah,
is going to be huge, right?
yeah.
Um, its GDP is probably greater than a lot of developed countries, right? Its GDP would
Oh,
probably be greater than a country like Switzerland, Sweden, or whatever. But does
yeah.
that mean that people on average are more wealthy in India than Sweden, or Switzerland? No, right? So you have to kind of look at it
Oh,
from a GDP per capita perspective, GDP per person, GDP per population.
okay,
So
okay,
GDP per capita is something that I look at. I also like to look at GDP per capita PPP, which is that you have a GDP per capita, but then it's adjusted according to purchasing power parity. So you hold a country as a
okay,
standard and be like, okay, it's like for example, in the US, if you're in California, if you earn $1,000, you would be poor a month, $1,000 a month. If you
okay,
earn $1,000
okay.
a month in suburban India or like say rural
Yeah,
India, you are rich, right?
yeah,
So you have to kind of
yeah,
adjust it to purchasing power parity, right? Because of the costs that
yeah,
exist everywhere. At the same time, if you're in California, you're probably not earning $1,000. You're probably earning a lot more than that. And at the same time, if you
yeah,
are in rural India, you're probably not earning $1,000. You're probably earning like 300, 400,
yeah,
and you're probably happy with that. Those are also the
yeah,
realities that you have to grapple with. I'd like to think that like the purchasing power parity adjustment is good. When you have GDP per
yeah.
capita PPP, you kind of adjust it to purchasing power parity, and that's good. I also like to look at the Gini or the Gini coefficient, which measures how much
Okay,
inequality exists in the country. Um, where from 0 to 1,
okay,
there is a scale as to how much unequal your country is. Um,
yeah,
and the higher that number is, like the higher the inequality is, the worse it is. Um,
yeah,
and that's very important because obviously there will be some inequality because meritocracy, if you
yeah,
want to have some level of meritocracy in a country, you have some level of inequality. That's fine. But if the
yeah,
inequality is so great that the richest person in India, for example, is one of the top 10 richest persons in the world versus the poorest person in India doesn't even have access to sanitation, that's a massive problem, right? That is a
yeah,
massive problem in a
yeah,
country. And at that point in time, it doesn't matter if that GDP per capita is that high. The poorest people in your country are not doing that well. Um,
yeah,
so that can be a way of measuring it. So it's one of those things where you have to balance, again, like in
yeah,
economics, in everything you have to balance a bit of like, do
yeah,
we want more inequality at the expense of more growth or not? I would say
yeah,
however that when we look at like, I am also, even though have studied economics, and as an economist I would have to say growth is always a good thing. I'm kind of getting tired
yeah,
of looking at growth all the time and saying that it's great even though our environment is going like getting degraded,
yeah,
even though we don't know 100 years later if the earth will be livable anymore, even though the poorest person in the
yeah,
country still doesn't have access to the basic needs. Then
yeah,
like you have to ask yourself, where is that GDP growth going? Like the
yeah.
question is, if your country is going by 6%, whose income is increasing by 6%? Is it the average person's income that's
Oh,
increasing by
okay,
6%? Or is it the
okay,
poorest person's income that is increasing by 6%? Or is it the richest person whose income is actually increasing by 12% and everyone else is actually losing money, but on average it's still 6%?
yeah,
So you
yeah,
have to put every number, every data point into context, because as like someone famously said, if you beat data points enough, it'll say the truth that you want it to say. um,
That's
we don't
true.
want that. We want it
Yeah,
to be that like the worst person in society is still at least has access to the basic living necessities, and we should be looking at that
yeah,
as much as we look at the GDP per capita and how much it is growing. It is also true that once GDP starts growing, that usually does improve the situation for the poorest person in the country, because at least someone they know has a job, or they can have a job, or they can earn some money through whatever means,
yeah,
because the overall economy is doing great. So, for
yeah,
example, when GDP growth happens in a country like, say, Malaysia, which used to be quite poor but right now is middle income, that has happened to manufacturing jobs, and that has provided jobs to millions of people in a place like
yeah,
Malaysia, that has resulted in their standards of living increasing because they're working in a factory, they're getting a livable wage. So now
yeah,
they weren't going to school, but their next generation is going to school. So their
yeah,
children are going to school. Their children are able to afford maybe going to a university because they are able to save enough money to be able to send their kids to university.
yeah,
That is progress. That is good. So that kind of growth is very good. But if you have the kind of
yeah,
growth where you're having growth, but you don't know if it's affecting the if it really is serving the purpose of the majority of the people, that can
yeah.
be a problem.
Oh, okay, great. Because every time I listen to you and then I'm like, what exactly are we being told in the public sphere then? Because point blank, I would listen to almost every political analyst representing different political parties in Ghana, even in world, like let's say the US elections is coming up and all that. And you'd always hear, yeah, but GDP grew by this percentage under our time, but GDP grew by this percentage under our time, GDP dropped under these guys. And yeah, like, but on the ground, people are like, yeah, the GDP grew, but we are struggling. So where exactly is that growth coming from? But then listening to you explain that, look, a lot of the time this is more like the output of the country, but it doesn't reflect where exactly it's happening at. And these other indicators are much more probably objective, measuring inequality, measuring exactly GDP per capita would probably be much more helpful. And I think these are some of the things that citizens also need to probably interrogate political reporting properly, but also make much more informed decisions for themselves. And I think some of these things, a lot of the time we say yeah, they are difficult, but they are also very important for public and civic education. A lot of the time we make it about, yeah, let's understand democracy and go and vote. Sure, but if you don't understand the things and the language that these guys are communicating in, how do you even make an informed decision about who leads you next or understand which governments are the best? I think it's really been an informative episode with you discussing. This is probably my most my most informative economics discussion I've had. I've learned a lot. Usually, what tends to happen to me is after some of these episodes, I just gain an interest to go and read a lot more about some of these things. And this 1 hour discussion with you has created that desire. So I'll definitely go back to read on further on some of the things that you've spoken about. Thank you so much. Thank you so much for joining us on this episode. I don't know if you have any final things you'd like to say. Let me ask you this as a closing question though. How did you feel in prep when you had that world's finals motion, uh, which was an economics motion, and you were there thinking, oh, okay, now this is my sphere? Were you like, because there's usually this notion that people who have done a certain program, when you get topics from there or motions from there, you tend to not drop down to the average intelligent person's level, so they don't understand you. And a lot of the time we blame, like in my circuit, for instance, law students face this criticism a lot. That a lot of the time they debate legal motions as if they are in the courtroom or as if they are in a law class, as opposed to in a public sphere where they need to discuss it on a fundamental level. How did you feel in prepping for that motion? Did you have that fear of being above everyone and that accurate knowledge then deflating your convincing nature? Or were you pretty confident about exactly how you were going to persuade people about the very right things within that motion?
I honestly have never had that problem with economics because
Okay,
I have learned economics in the most like I don't understand economics unless I break it down to the layperson's level myself. Like I have to
okay,
like okay, I'll understand the theory. I'll be like, okay, but how does it happen in the real world? I have to map it out in my head. Otherwise I don't understand it. I cannot
yeah,
just memorize things. I cannot just be like modern monetary theory says. I just don't believe in that myself. So
Yeah.
if I can do that economics debate, then I can do that economics debate and I can explain it to like at least the level of judging that we get in a world's final, right?
Yeah.
And
Yeah.
seeing that motion, initially going into that world's final, I had two feelings, right? One, have to win that world's final, but at the same time, you're like, okay, you got to a world's final. That's a massive achievement on its own. Once I saw that motion, I think the second
Yeah.
feeling just went away then and there. When I saw that motion, I was like, I really have to win this. Like, there's no way. Like, this is like, it couldn't have been more sort of
Yeah.
opportune. It's like
Written in
it's
the
one of those situations
stars.
where like it's a World Cup final. There's a tap in front of you. You don't miss that open net in a tap in. You don't miss that tap in, right? You don't do that.
Yeah.
Like, there's
Yeah.
only the goalkeeper in front of you. You have to kind of score it through that. But you do not have, like, that's the same thing that happened with Arjen Robben in 2010 or
Yeah.
Higuain in 2014. They had the goalkeeper in front of them. They missed that shot and they couldn't score. I didn't want that to
Yeah.
happen because that was the feeling I had. Like, I had to just beat the keeper and score. That's it. But obviously the complication was that, like, in opening government we had Ateneo, who we had
Yeah.
debated for so long. Princeton was a team that we knew was amazing, but we hadn't debated them as many times. The same with
Okay.
NUS. We knew that both these teams were great. They were not in our bracket. We didn't really face them as many
Yeah.
times in the prelims. We just did not know. Ateneo, on the other hand, we've been facing for like us and Miko, we've been exchanging blows for the last three years or so.
Yeah.
And then David also came in at that point in time. We knew that they were going to be formidable because they are also amazing debaters in economics.
Yeah.
So at that point in time, like, seeing the position, we're just like, well, we have to just make sure that we beat Ateneo. We have to make sure that we play to our strengths because this is to our strengths. And
Yeah.
then obviously you don't have control over the bottom half of the debate.
Yeah.
And they're amazing debaters, so you don't have any control over that. But you need to do what is under your control, which is
Yeah.
doing to the doing to the
Yeah.
fullest extent. So that was my feeling when I saw the motion, that like it's just like beating the goalkeeper. That's it.
It's like, I don't know, but I did biological sciences in school. I almost always never tend to meet any biological science related motion in debate. And so it's always like, I'm waiting for that one day. And I can imagine like that feeling, especially when you meet it in one of the most important rounds, probably the most important round for you
Yeah,
in your
yeah.
debating career to define exactly the crowning moment. So, I mean, congrats on winning that final. Probably
Thank
a
you.
long belated congrats, but still worth it anyway. Because, yeah,
Thank you.
because I think that motion, for instance, and that final created a trend where in that subsequent year, people got a lot more into economics motions. People got a lot
Yeah,
more understanding of the way in which economics went because they were like, oh, if that's a world's final standard motion, then it could appear anywhere. And it created an inspiration for more economic knowledge as well. So that was a really good one. I mean, thanks so much, Shorodip, for joining me on
thank you
this
so much for
episode.
having me. Really enjoyed
Yeah.
it.
Thanks everyone for joining us on this episode. As always, leave your comments, leave your likes, subscribe to the channel. See you on the next episode. Bye everyone.